Welcome to Brick by Brick. Join me, Loren, Wernette, as I share my personal journey of building a thriving real estate and hard money lending business from the ground up. Along the way, we'll explore the strategies, challenges, and breakthroughs that come with growing wealth. Whether you're a seasoned investor or aspiring entrepreneur, or simply curious about the world of private lending and real estate, this podcast is packed with actionable insights, real-world stories, and mindset tips to help you build your own path to success brick by brick. Welcome to another episode of Brick by Brick. I'm your host, Loren Wernette. Today we have a great host, Steve Csobaji. Practiced that before the interview started, so I did not butcher it. Steve works for Inspira, which is a self-directed IRA custodian, and we're going to get all into that because you have several investors in their fund that use that. I have a self-directed IRA, and we're going to talk all about that. Steve's been in that industry for quite some time and is going to give us an overview of who he is, and then we're going to talk all about self-directed IRAs, how you can use them, what to look for, and why you should be investing today. So, Steve, thanks for joining us today.
Yeah, thank you for having me. This is a real pleasure.
Yeah. So before we get too far in, I give a very brief overview of kind of who you are, but can you give us an idea of, who you are, how you got to where you are, and some of the experiences in this space that have really lent credence to, where you are coming from with this talk?
Yeah, absolutely. So my background is pretty broad and diverse in financial services. Before I started with Inspira, I actually worked in the pension field, where I actually worked with companies that were providing retirement benefits for their employees, that being 401ks, 403bs, defined benefit plans. And it kind of piqued my interest because as I was helping people prepare for their retirement, the thing that they were always craving were options beyond just what they knew by way of traditional assets. Most of them invested in pooled funds and mutual funds and things of that nature, but they were always craving the ability to invest in alternative assets, specifically real estate for the most part. And through those plans, that was not something available. So a few years ago, I started in with a company that was called Quest Trust Company. And there we were exclusively just a self-directed IRA custodian. Now, a little less than a year ago, Quest merged with Inspira Financial, where we still act as a custodian, but now we are kind of executing on the vision that the founder of Quest had, which was to go next level. At Inspira, we do a lot more than just self-directed IRAs. That's still one of the bread and butter and the cornerstone of the company, but we also do things like traditional investments. We have a 1031 qualified intermediary. We do fund custody for people who are setting up pooled investments and want to attract investors. So we really are now kind of a full, broad financial services organization now that happens to do self-directed investing as well.
Awesome. So as we talk through this, maybe just set the stage a little bit so everyone's kind of the same. Explain to people what a self-directed IRA is compared to, a traditional IRA, and then also define an alternative investment asset.
Sure. So first of all, I'm going to correct a misnomer that a lot of people have. I like to ask this question when I'm in front of a group just to kind of put them on the spot a little bit. But IRA, it does not stand for individual retirement account, like everybody thinks. It's actually individual retirement arrangement. And basically, if you know what an IRA is, you know what a self-directed IRA is. I would argue, in a way, every IRA is self-directed. And what I mean by that, Loren, is that as the investor, I get to choose the company I set it up with, and I get to decide what to put my money in. So that's kind of what you would say is self-directed. Now, the difference is that with a truly self-directed IRA, you're setting up the IRA with a custodian like Inspira, but then you get to choose the investment. The distinction is that if I go to Vanguard or if I go to Fidelity, I buy what they sell. That's where my choices are. And when I put my money in, I don't have any more say over it in that mutual fund. With a truly self-directed IRA, again, you're using those alternative assets. They're private assets. So they're things that aren't on the stock exchange. Not everybody may be able to invest in it, because you might have to be accredited or you might be invited to invest in it. So the alternative asset, I guess is probably the right word, is again more of a private asset. And that can be everything from literally a piece of property. I could literally run an Airbnb through my IRA, or a short term rental, a long term rental. I could literally have a piece of real estate titled through my IRA. Most often, it's more passive investing. So it's multifamily, but the multifamily model, it follows along with things like car washes. RV parks are becoming very popular, self storage. It also goes into things like oil and gas. Private company stock is something we've seen. I've had a couple of clients in the recent past who work for a privately held bank that is allowing employees to get in. So they're doing it through their IRA. It's also things like private lending. So let's say you and I wanted to engage in a transaction. Perhaps you wanted to do a fix and flip. I could lend you the money and take a lien position on the property. Then you've got the money. You pay me back. And so I'm passive in the deal, but I'm putting the money in real estate that way with something that's secured. And the lending can be very creative as well. It can be secured. It doesn't have to be. It can be unsecured. It can be secured with other types of property. I've seen some interesting things in my time. I saw a veterinary clinic once, which the IRA holder actually had to collect on and then had to turn around and resell to recoup their investment, which they were able to do. I've seen dental equipment used. My favorite is I saw somebody who used ammunition actually as collateral one time. I mean, that's a Texas thing here where I live, I think, primarily. But again, you can be very creative with the lending and the collateral that you use. So that's part of the fun of the self-directed IRA.
Yeah. So I have experience with these. And when I left my W-2, I had a 401k, transferred that to an IRA, and then transferred a chunk of that into a self-directed IRA, which then I moved into a real estate fund. And so it's allowed me to diversify my my retirement portfolio outside of the traditional stocks, bonds, mutual funds, into an asset class that I'm very, very familiar with, and take advantage of the tax benefits of having my retirement money out there in an asset that I'm familiar with, which is real estate.
I think you just hit on probably one of the most important things is, again, if you're going into a mutual fund, let's say, again, you don't have any say, and you may not really know the ins and outs of the stock market and what's going to make it go up or down. But when you use that self-directed IRA, because you're selecting the asset, like you said, you get to leverage your expertise. The fact of the matter is that in Inspira, we don't sell investments. All we do is administer the IRA and give the client the ability to put their money into the asset of their choosing, which again can reflect their preferences a little more so. And you touched on another thing that I think is also really important. They always, experts out there always stress diversification as being one of the most important things to do. Well, in the traditional asset world, it's actually harder to get diversified more so than one thinks. There are only about between 3,000 and 4,000 publicly traded stocks. There are over 18,000 mutual funds, ETFs, pooled investments. So if you're investing in those, you're probably buying more or less the same things. I mean, I think back to a client I had years ago, and I actually had a tool where I could drill down into the actual holdings of the mutual fund. And I showed him that he had a lot of money in the tech sector. Probably about 30% of his portfolio was tied into the tech sector. In fact, I was seeing something just the other day. The S&P 500 is mostly weighted toward technology, and it's only in about the top 10 stocks. So if that sector isn't doing well, that's going to really impact the performance of the S&P 500, which we think of as being 500 stocks, so it's so broadly diversified. But the point is, and again, I think this amplifies what you were just saying, now you're in an asset class that you know well. So you've done the homework, you've done the due diligence. You're probably going to be a lot less surprised by the outcome. But now you're in a non-correlating asset. So if the stock market should be doing poorly, your asset that really diversifies you could be doing well. And we've seen that in the recent past.
Yeah, I think you nailed it right on the head there. I think the other piece that I really like is that I get to bet on not only the horse, but the jockey. Who is running these companies? How are they running? And get to really see the inner workings of what's going on there. You put money into Apple or whatever, and they change CEOs or something happens. Like there's all kinds of swings in the market. And you really don't have any idea what's holding up that stock price. And this is nothing against stocks, right? I hold ETFs, I have stocks, but there's no say in how things are run. In some of these small companies, I know who exactly is the owner of that. And in some cases, they can look at what are the hard assets that are backing my investment and do the underwriting myself because I know how that's done to see if they're making solid loans or if they're making good investments with my cash.
Precisely, precisely.
So, with these type of assets, I think that there's a lot of people that maybe aren't even aware that you can take your retirement funds and put them into things like this. Do you see that regularly? Do you see shock from customers that I didn't know I could move IRA money out of the stock market and do other things with? And what do you think is the number one deterrent from people doing more?
Well, you're exactly right. I mean, it is an educational process. A lot of people, again, myself included, I mentioned years ago, I didn't even really know you could do this as well. They assume that real estate is something that you just wouldn't use. Again, buying a house seems like it might be very expensive. So it's something that people don't find attainable. Now, again, through things like multifamily, you can do it with a lot less money when you're a passive investor. So I'd say that's maybe the two hurdles is a lack of knowledge of this being an option, but it's also a preconceived notion that it's expensive. And at the end of the day, I think actually you could demonstrate that a self-directed IRA is a lot less expensive than anything else that's out there, even no load mutual funds. So when you look at kind of how they charge their money, what they really do is kind of hold back what you would be making when they take away that expense ratio. Plus, there may be commissions involved. There might be ongoing asset management fees. So there are several layers of expenses. With us, it's simple administration. That's basically all we're charging. The investment, again, what happens in that, sometimes there might be a management fee, but that's always very nominal from what my experience is. But that's probably the other big misnomer is that it's too expensive for the individual to do.
Yeah, I think I could see how someone would think that. I found that my self-directed IRA is pretty much cheaper than anything. Even my ETFs that I have, they have a very small cost ratio. But the self-directed money is basically an annual fee plus maybe some transition or transaction fees. And I don't move money that often, right? Because money that's moved is lost. I like to set it and forget it. I think the one piece, and I'll challenge you a little bit on the cost, isn't just money. It's on the time. With self-directed, there is a bit more time that you need to do, at least learning to know where to put the money and then to keep an eye on it. Because if I just put it into Microsoft or something, I literally can forget about it for 50 years and it'll probably go up, right? And I think studies have even shown that people that have passed away, their portfolios do better than people that are actively moving stuff around on a regular basis.
Yeah, I mean, buy and hold has always probably been the more effective strategy than people who try to time the market. And again, typically I think, in my experience and what I see, you are kind of doing a buy and hold on these real estate assets. They're not liquid, so they're not something you can flip. But, in terms of their valuations, they typically only do it once a year. So, it's not something that you have to babysit and wonder about every day. You're right that that doesn't mean you don't pay attention to what's going on. You do want to, of course, always do your due diligence and keep up on, the progress of the investment. I know in the multifamily that I do, I work with a really great company. They're very proactive in terms of talking about the status of their projects. I'm getting updates in terms of things like occupancy and the rental rates and how they're performing. So again, sometimes it does come down to the operator that you're working with.
Yeah, 100%, right? You got to bet on the horse and the jockey. So for these type of vehicles, the self-directed IRAs, or we can even talk Roth IRAs for that matter, who are they not going to be a good fit for?
I think maybe it's the people who don't have the time for the investment horizon, if they don't want to tie up their money. Because again, the one thing that a self directed or an alternative asset lacks, we just touched on it a minute ago, is liquidity. If you are older and you're in a position where you need to start taking out that required minimum distribution, these are illiquid assets. Now, it goes back, I think, importantly to a point you just made a second ago. You shouldn't have your eggs all in one basket. I mean, I too would argue that there is a place for traditional assets as a part of your portfolio. Alternative assets should probably be that smaller diversifier because they can be more aggressive. And the thing about that required distribution is that you can take that across your IRAs. If I have some money that is tied up in that alternative asset, they're going to calculate the amount of the RMD based on what that value is. But I can take all of the RMD out of another IRA and satisfy that requirement. So it doesn't mean that you can't do it, but again, you just want to be cautious about doing it.
Yeah, makes total sense. I think time is the ultimate cure all, right? But you got to make sure you're making smart decisions. And just
Yeah.
because
And another thing which is kind of interesting is even if you were somewhat tied up in an alternative asset, this is something I wouldn't want to go through myself because of the way you'd have to calculate it. But you can actually technically distribute an asset from the IRA. So if I did have something tied up in an alternative asset, I could change the titling of the asset to reflect the IRA and myself personally, and that would actually count as a distribution. Now, I'd have to pay taxes on what the value of that portion of the distributed asset was. But again, just because you have something that is illiquid, it still doesn't mean that you can't get the money out of there to satisfy that RMD if you're in that situation.
Yeah, and I think it's important to note that all of this stuff is things you should talk to your CPA, your accountant. I am not a tax professional, nor do I claim to be, and so talk to a legal representative or fiduciary for these type of things. Entertainment purposes, information purposes only here.
Absolutely. We too at Inspira, we don't offer tax, legal, or investment advice. Again, that's part of what self-directed is that you are really the one taking control. So you really have to be the one who is kind of driving the bus there a little bit. So yeah, we definitely always say we can guide you a lot in terms of using the self-directed IRA, but we don't evaluate the investment. We don't tell you if it's a good or bad deal. There are probably very few reasons that we would actually step in and say that we can't do the investment for you.
And the primary being that you forfeit your rights to the tax preferred status of your IRA. That
You
would be the
potentially
main reason.
could, and that, believe me, is not something that you want to happen. Just because of what the timing would look like and accrued penalties that you would probably encounter, and when the IRA is potentially disqualified. So yeah, it would be a mess if you kind of got into one of those prohibited transactions.
Yeah, you definitely want to stay away from those.
I
You
tell
don't want to
people all
take.
the time, the IRS is many things, but stupid isn't one of them. So if they really want to get at you, they have the ability, and there are things that are in the tax code that are written in a very vague way that favors them. It gives the IRS the ability to make the interpretation if you should be audited.
Yeah. And I think that, so I'm not even 40 yet, I'm 39. And I think that from a retirement standpoint, it's very easy to look at this chunk of money that I've set off to the side as I can't touch that for 25 years. So let's try to get it big, but I'm not going to, doesn't seem real, right? And so I think to making sure that you don't make it real too soon and then have to pay a huge chunk of taxes on it, because that's what will happen if you disqualify it. It becomes a very real risk. And putting it into proper investment platforms that will grow over time and not trying to win the house in one hand.
Exactly.
So what have you been seeing this year? So like my retirement, I've got basically two streams. I got my stuff that's in my self-directed, plus I have my ETFs. My ETFs have been extremely volatile. They took almost 100,000 loss at the beginning of the year. Now they're back up to where they started at the beginning of the year. While my self-directed with real estate's been nice and flat. What have you seen from a market standpoint over the course of this year? And what are you kind of expecting for the rest of this year? And how should investors kind of take that into account when they're looking at making decisions in the coming 6 to 12 months?
Yeah, it's funny because the outlook on the market I think has changed a lot in over the course of this year. I was hearing people at the beginning of the year using the phrase survive 25, thinking that the real estate market was going to be somewhat volatile or flat, or kind of take a step back, so there wasn't investment opportunity. There was always the worry about where interest rates are, which seem to be holding up some deals. I would say the market has kind of changed a little bit in the year. And what I've been finding is that some of it, the old adage about real estate, that it's based, the three things you look for: location, 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 is that some of the deals are based on kind of where those individual markets are. I live in Dallas. The Dallas market has been, I think, more resilient, certainly more resilient than Houston, Austin, San Antonio here in the state. So a lot of money has still been flowing into Dallas, and there are some deals being done. I'm still hearing that in Arizona, in the Phoenix area, that there are deals being done. Salt Lake City was, to me, I mean, I don't know much about Salt Lake, but that's been pretty fertile ground. And in the last several weeks, I've even been seeing places like Omaha that are picking up. Some places along the East Coast, which I think a lot of people feel are overvalued or too expensive to get into. I'm seeing deals there because I'm seeing some operators that really know how to work that market. So surprisingly, there are still deals being done. And then what I would also say is, again, remember, it's not just real estate in the sense of multifamily. That's probably where we typically have seen the most, but that's part of the area that has been a little vulnerable this year. So some of the other things that we discussed, self-storage has been strong. Self-storage is actually a pretty resilient asset class overall from what I've seen.
Mm-hmm.
It seems to actually kind of do well even when the economy doesn't, for various reasons. Car washes, again, are becoming something I'm seeing a bit of. Oil and gas, that has been kind of volatile in many ways, but it's also been fairly resilient based on who the operator is. So, there are still deals that are being done in this alternative asset, private asset space.
Yeah. And so we've seen that as well. So our company, we track a lot of the macroeconomic trends across the country. We have for a couple of years now. And when COVID hit, we saw this huge spike in Florida and Texas of people moving there, of days on market dropping, of prices just skyrocketing. And then other parts of the country, the Midwest specifically, and some states in the East Coast, specifically North Carolina and South Carolina, they went up. The Midwest went down a little bit, but the Carolinas went up, but at a slower pace. And I think we're seeing a correction now. Texas, I talked to a guy this morning who has a coworker in Texas. They're seeing a huge slowdown in new builds sales. And so a lot of those customers, they're just not getting inventory off their books quick enough. And so those builders are not buying land right now because they're trying to get inventory off. The same thing's happening in Florida. In the Carolinas, on the other hand, condos have seen about a 1% decrease in sales volume just because there's been such a huge push of number of people moving in and condos coming in. But the single family homes in that 1,600, 200 square foot range, those are about a 1% increase in sales volumes. Days on markets have come down. And so we're still seeing a strong forward trend in regionalized sections of the country. Midwest is still strong in that way as well. And we just are seeing some of those corrections that happened after that weird oddity of COVID in 2020 and all the shuffling of people that happened.
Yeah, that was a game changer for sure.
For sure. What else have you seen on the directed side, self-directed side from an investment standpoint? Are people holding their money more right now? Are they, kind of waiting, taking a wait and see approach as these market volatility kind of continues and potentially continues on with the tariff stuff that's going on? Or are people still aggressively kind of moving money around to make sure they're taking advantage of opportunities that are showing up?
Well, I'd say it's maybe a little of both. Again, there are some people who are still a little skittish. They maybe think that some of the things in the market are overpriced or that interest rates are going to hold back. But I think that again, I can tell you anecdotally, we are seeing a lot of money come into Inspira. So people are getting ready. They either have deals that they already have in line, so the investment opportunities are there, or they're bringing it over, waiting to pull the trigger because they anticipate that the deals are going to come soon. And I have a feeling that something is going to break the logjam. Again, there is a lot of uncertainty. Every day we hear something different about things like tariffs. And there is going to be that ripple effect that's certainly going to impact construction and things like that. But, the news is good one day and it's negative the other. And again, I think you were mentioning your ETFs. As of Friday, they hit a peak, and then Monday came and we had a 400-point decrease in the market. And so they slumped again. And today's Tuesday, I haven't even looked. So who knows where things are today. But, again, there's definitely dust that needs to settle before I think a lot of the money moves. But like I say, I see a lot of operators out there that are they're deploying money. So there's got to be something, there's got to be opportunities. Because again, I'm seeing it in some very different places, even places like New York City and New Jersey. So, again, there are some people who are working these markets and they're finding opportunities out there.
Yeah. And when you say money moving into Inspire, is this people that are new to self-directed that are bringing money in to deploy in alternative assets to move away from the stock market? Or is this people with additional capital that are just continuing to add into their self-directed IRA holdings?
I would say many of them are new. So they are the people who are getting educated, they're finding the opportunities. And frankly, again, I was part of something not too long ago where I was informed, or, the speaker was talking about how private placements are now becoming more of the place where you're going to find equity plays. Again, the market is somewhat saturated and more companies that are publicly traded are actually consolidating. So to buy equity in a company, you kind of have to go the private route. That's what a lot of companies are looking for these days, especially because they don't necessarily want to be answerable to Wall Street. But we do still are seeing people that have been, long-term self-directed investors who have deals that are coming to a close and they're ready to find another deal as well. But again, I would say, to answer your question most accurately, we are seeing a lot of new money that is moving in, new accounts and new money.
Yeah, I think so as I've been in this space, the lending space, and in the working with a lot of accredited investors over the last couple of years, I've really noticed that there's a lot more opportunity to make larger returns in that space that just aren't common knowledge to the everyday person, right? You're working a 9 to 5, you stick your money into a mutual fund or whatever, you kind of forget about it and you get your solid 7% returns. And then the people that know the game and can have the accredited status or an additional status above that can get their money into some of these assets or into these opportunities that are returning 20, 30, 40% returns per annum. They take a higher risk and you have to have higher input into it. But those kind of opportunities just aren't available to the general public, or at least they aren't available without having some significant work or knowledge. There's a knowledge gap, I guess.
Yeah. What's interesting, Loren, is that even on the accredited side, I'm seeing that a lot of the minimum investments are lower than you might think. Typically in the past, we would see typical minimums around $50,000 for the investment. Some of the operators were even higher than that. One in particular that I know of was 75 as their minimum. What I'd often see is that, especially with the operator, sometimes people were going in with more than the minimum. However, I am starting to see that some of these minimums are coming down to the range of 25. Some of them are even lower than that, which means that the self-directed is more accessible than ever before. You might be able to get in with an IRA that you made a couple of years worth of contributions to, meaning that, if you're not willing to move that IRA or you don't want to move that K just yet because you want those stocks to recover, you still have a way to get in to the self-directed game without overexposing yourself to it.
What do you think's driving down that minimum? You think it's trying to compete with the crowdfunding Schedule A stuff that's out, or is there another reason that the
I think
minimums
that could be it part and parcel, but some of the companies that I've seen are actually committed to having lower amounts because they want the ability for people to get into these things and they want to attract the investment. Now, as I mentioned, some of them you still have to be accredited to do. So it's not like everybody can necessarily get into it. But I like to think that as people know more about self directing, there's going to be, the word I like to use is a democratization of this area where more people are going to be able to access these types of alternative assets.
Yeah, that's interesting. And so for the listeners, accreditation is a SEC term. It basically means that if you're single, you make $200,000 a year for the last 2 years, or if you're married, $300,000 a year with no reason for that to change in the future, or have $1 million worth of net worth, excluding your primary residence, or have like a Series 7 or a Series 32 or whatever license. Basically, it's a way for the SEC to ensure that you are savvy enough as an investor from a financial standpoint to not put your money into a risky situation that you could lose it. And if you do lose it, you are not going to be significantly financially impacted on day to day. They don't want grandma investing in something, having it lost, and her being out on the street, essentially. Yeah, that's interesting. From a fund standpoint, and this is just my perspective, the move to a lower down payment or a lower minimum is curious to me because you basically are increasing the number of investors that you need to then manage, which creates more struggle, or not struggle, creates more overhead. But it also de-risk you if you have, a lower average investment per investor, and one of your investors leaves, the chances of that investor being just a smaller portion of your portfolio is probably good. And they could also use it as kind of a low barrier to entry, because what we've seen is the first investment is usually near the minimum, and the second investment's like a 2x of whatever that is, and then the third investment's like sometimes 5 to 10x the initial investment. So getting people into their platform, showing them what they can do at a low barrier entry, I guess they could see some benefit there as well.
Yeah. It's kind of interesting because some of the deals that I've seen, the capital raises aren't that big. They might be in the 2 million range or the 5 million range. So in those cases, what I assume is that they can do smaller minimums on it. Now, interestingly, with a lot of those types of investments, and depending what it's filed as, whether it's, the Reg D, Reg A, they will cap the amount that you can do, that they'll take from IRAs. So for various reasons of how, their responsibility may change. So that is another reason that perhaps that they are willing to go maybe a little lower in the area of the IRA.
Makes sense. So if somebody, let's say somebody has a 401k that they can roll over, or they have an IRA and they want to get started and move some money into a self-directed IRA, what would you recommend as kind of the first step for them? And maybe just walk us through what the process from rolling, and let's use Fidelity, rolling an IRA that's in Fidelity over to Inspira looks like, and then what it looks like to get that into whatever investment vehicle they choose.
Sure. What I'd say first and foremost is, before you set up that self-directed IRA, do some homework on the custodian. Not all custodians are created equal. This would be the point where I make a self-serving comment about Inspira, but I'll
You forgot your
that.
shirt. You got a shirt with the Inspira logo.
I missed that opportunity for sure. But again, you want to look at the custodians. You want to see, what I would say is, one thing, definitely interview custodians, talk to one of the client service people there. You can get a sense as to their knowledge, which I have found is not equal in every place. I've sometimes done some secret shopping of our competitors, and I've been a little surprised by some of the answers I've gotten when I ask some basic questions. But again, I think one thing to evaluate companies on is the fee structure. There again, you got to really do your homework, because what I have seen on multiple occasions is that one fee, like the annual administrative fee, may seem higher in one company as opposed to the other, but that lower company that has the perhaps lower fee in that one end has some other embedded fees that the other one does not. So again, really make sure that you're looking at those fee schedules, and again, things like the service and ratings and things like that. Once you have selected your custodian, and I hope it will be Inspira, then the next step is that transfer, as you mentioned. An IRA transfer is very simple. What you basically do is you fill out, in this case, it would be the Inspira transfer form. You always fill out the form for the company where the money is going into. We initiate the transfer with that company, and then they send the money to us. So again, the client has to do very little in that case. It's a non-taxable move.
I think it's important to note that you, as the owner of the IRA, can never touch them.
Well, you certainly don't want to. There are cases where you can, but there are rules that surround that. As with an IRA, if I took the money, I have 60 days to get it back into an IRA, and that will trigger some tax reporting, even though it's going back to the IRA. And that's something you can do once every 12 months. So it's not something you can do all the time. Whereas that transfer custodian to custodian, I can do as much as I want. So I can move money between different companies. And again, there's no harm, no foul. There's not even tax reporting that's done. Because in the eyes of the IRS, it's really never leaving an IRA. Now, the process is a little different if I'm coming out of a retirement plan, a qualified plan like a 401k or a 403b. That's where the client does actually have to do a couple of extra things. They set up the IRA first, and then they have to go to the plan provider. Again, that's not necessarily the company. That could be the company that manages the retirement plan, like a Vanguard or a Fidelity. You have to request the distribution, and you have to be sure that they're making the distribution payable to the IRA, not to yourself personally. If it's made payable to the IRA, you avoid what would be otherwise a mandatory withholding, and you avoid any kind of tax or penalty that you might also be subject to by taking the funds directly. So it's just a case. Again, talk to your custodian. They will walk you through the process. They will know if it's a retirement plan, how it works, if it's an IRA, how it works, and they'll be able to competently guide you to make sure that any impact to you is minimized as much as possible.
Perfect. So now you've got your money into your self-directed IRA. What are the next steps to get it to where it's actually making money? Because it's in self-directed IRA, not doing anything, right?
Well, again, you do your due diligence on the investment. You thoroughly research it. You vet it. You maybe work with an investment advisor or a legal advisor or your CPA to do some of that vetting. Once you've made that decision, now it's time for you to tell us what to do. And that's typically done by what's called a direction of investment. You can do it through our portal. You can literally do forms if you wanted to do it kind of in an old school way. But basically, you're submitting the forms, and there is some documentation that we need to review. It's typically the PPM, the private placement memo, or the subscription agreement. It's those kinds of things that define the transaction. Through those PPMs, we will review it. And again, what we're going to ensure is that there's nothing that's red letter prohibited. Again, we won't tell you if it's a good or bad deal or make any kind of evaluations. We'll just make sure that there's nothing in there that's going to get you crosswise with the IRS. And then the subscription agreement basically kind of defines the transaction. It says, I'm putting in $50,000 and I'm getting, 5,000 units of said entity. So now we create that asset, and now that is what's in the IRA.
Yeah. And in at least our case, we always work if our investor says, hey, we're going to use Inspira. We're going to reach out directly to you, Steve, or somebody that works for you, provide the PPM, provide the subscription agreement. We try to do as much of the paperwork as possible and just leave the signatures and the stuff that the investor needs to do. We're trying to remove barriers from getting their capital into our fund for obvious reasons. But we also want to make everyone's a smooth transition, right? You guys are paid to make sure that you're custodian for their money, and we're paid to manage their money, once they get it into the fund. So that's kind of the goal.
And that's, I think, one of the great value adds to a provider like yourself, if you're really helping them. Probably the most common mistake that I see people make that requires the documents to go back is, again, in that titling. Any of the titling has to be done in the name of the IRA, not in your name personally. And that's, again, when people are kind of doing it themselves, they make that mistake and we have to kick the forms back and get them retitled and that kind of thing. But when the company who really kind of knows the process is a little more involved, that makes it that much smoother.
Yeah. I think the timeline has usually been 2 to 4 weeks from the time that they say go to when the funds roll. It could be faster. It just depends on, honestly, it depends on how fast everyone turns paperwork around.
That's correct. And again, the paperwork being done correctly, our time frame, has gotten less than that. And in fact, in Inspira, we're driving to a point where we're going to be able to do it. The goal is within 24 hours. Now, we're not quite there yet, but again, if we get the forms, pretty quickly and they're all in good order, we're pretty quick.
Yeah. My experience, nothing against any of my investors. It's usually the investors who have day jobs and, real lives to do stuff with. That is the holdup, waiting for them to sign subscription agreements or fill out forms or something.
I'm guilty of it too.
For sure. Same here. I know I was the holdup on when I did my self-directed IRA of getting that money moved. Talk to me. We talked about fees a little bit, and you don't have to specifically talk about Inspira, but so there's an annual maintenance fee. What other fees could this type of asset have that an investor has to think about when they're looking at which custodian to use and if this is the right move for them?
Sure. The big one is, again, that administrative fee. And that fee, again, can be varied based on the custodian. And what that does is it incorporates the filings and the administrative tasks that the custodian does. So it's tax filing, it's record keeping, it's all those things that, again, keep your IRA compliant. Now, again, like I said, not all fee structures are the same. Sometimes there can be a transaction fee. In the case of Inspira, that's embedded to just an additional fee that we charge on an annual basis, but that covers the transaction, that covers things like the account opening. But again, account opening fee is something I see a lot of. Account closing fee is something I see a lot of, where, when you're done with the investment, they charge you on the way out the door. Typically, there might be a wire fee for sending the money into the investment. So those are some of the little things that you have to really take a look at. Again, I would never name names. I'd never disparage a competitor. There is one fee schedule I was looking at just recently. They actually had tacked on an annual fee for the percentage of the investment. That was the first time I'd ever seen something like that. So again, that administrative fee was a little lower, but on a $50,000 investment, they were actually charging you, I don't remember what the expense was, but they were charging you a little bit of what the value of that asset is. And as the asset grows year by year, that fee gets higher year by year. So those are some of the tricky things. Again, you really have to pay attention to those fee schedules and see kind of what the charges are related to the administration and the overall holding of that asset.
Yeah, I think it's important just to level set here that, when we talk fees, you're talking like hundreds of dollars a year, not thousands of dollars, at least in my experience. Mm-hmm. So, don't think though we're talking you're going to take $10,000, $20,000. I think my annual fee I pay is like $295 plus $50 transaction fee. It's pretty nominal, really. And the other thing I do is I pay for that with a credit card versus the actual money in my IRA, so I can let that money continue to accrue tax-free and pay with money I've already paid tax on. So
yeah, good points all.
So, all right. So is there anything else, as you're talking about somebody that has very little experience with a self-directed IRA or new to it, that they really need to know about these to get started, or just anything that you think is interesting or worth knowing about?
Well, I'd have to say in most cases, what I find is that people are maybe a little more drawn to the passive investing. If you are owning real estate through the asset, first of all, like we said, that can be a little more expensive if you're buying the asset outright. Now, there are ways that you can finance through an IRA, but again, it's a little different than getting a conventional mortgage, which you're not allowed to have in an IRA. So again, there's a lot more that goes into it. Plus, through the IRA, you'd have to do things like pay property taxes, pay insurance. All that also has to be done through the IRA. Like you were saying with your fees, you can't do that personally and save the IRA because the IRA is on the title. So again, a passive deal is typically where we see people go more, and for many reasons. If you're in multifamily, you're not dealing, and you're passive, you're not dealing with the tenants and toilets, as they say. So it does tend to be a little bit better route. It's a good way to kind of dip your toe. And again, if even that isn't what you want to do, the private lending can be a good way to go as well. Like I said, there are ways you can secure it. There are things that you can do. And again, it may not be as great a return, but it is potentially a little more stable. And it's another good way to maybe just get a feel for it and see what it's like, and then move on to other things from there.
Yeah, I've seen people use them for flips. I've seen them for rentals. And from my experience, I think the more time you have to touch it and do things with it, the higher risk you have of disqualifying yourself. And so it's much better to find somebody that can do it, let you be passive. I mean, because at the end of the day, you've gotten yourself in the position where you have money to in an IRA because you're doing a good job at whatever that thing is, right? What is your W-2 or whatever? Focus on that, make more money there, and let someone else deal with your self-direct IRA, and don't risk exposing it to a disqualification of it.
Exactly.
So, all right. So I'm going to ask you the question that I ask everybody at the end of this podcast. Knowing what you know now at this stage of your life, what advice would you give to an 18-year-old you? Or what advice would you give to your children when they are 18?
I think, again, it's never too early to start with an IRA or saving for your retirement. Really, the only qualification is that you have to have earned income, W-2 wage, Schedule C self-employment, 1099, something of that effect. And I'm seeing that a lot of parents are helping with their kids, and they're getting creative in terms of how they can actually help them create that active income stream, because a gift doesn't count. I can't use that if I'm in a position and I'm gifting money to my children, that doesn't make them eligible to put money into the IRA. But the one type of IRA that I think most people really ought to consider is, especially if you're younger, is that Roth IRA. The value of that Roth is that while the contribution is not tax deductible, that contribution, once it goes in, is completely tax deferred. And that growth over time, as long as you hit certain qualifiers, that growth is going to come out tax free. And so what I'd say is think about it. If you're 18, 20 years old and you're starting to put that money in and you're even getting, a fairly moderate rate of return on it, the earnings are going to far outpace what those initial contributions are. So that is the thing. Time is your greatest ally. And I mean, we're starting to see already, that we don't necessarily know what's been put into this big, beautiful bill that just got passed. But, the outlook on some things that we were expecting to be there for ourselves may not, depending on how things play out. So it's going to be more and more incumbent on an individual to really take control of their retirement. So, I mean, that'd be the advice that I wish I could go back and take advantage of. Life happens. So it may be a case of where you're not always able to contribute to the levels you would like to. But while you're young and maybe you don't have as many expenses, putting that money away is going to be just the greatest thing to your advantage. The other thing about that Roth is that when you're young or when you're old, there are advantages where you can get some of that money tax free. We think of it as retirement when I would get that money tax free, but there are other qualifiers. There are things like a first time home buyer who can take money out of that Roth IRA and have it be tax-free. So it's not just a case of where I'm 18 and I won't see that money for years and why should I do it? I might be able to access it a lot sooner than I think and have some real great advantages to doing so. Again, that Roth is, I think, the critical thing that you want to take advantage of.
Yeah, the Roth is incredibly powerful. So people that don't know, Roth is taxed and then it goes in, where a normal IRA, it goes in and then it's taxed when it comes out. And so you're really looking at, where do I think my earning is going to be when I am able to pull it out? And is it going to be more or less than what I'm currently making? And if it's going to be more, you're in a higher tax bracket, right? And so then you want to put more money into a Roth. And if you think, oh, I'll be making less when I pull it out at 65, then you want to put it into a regular. And so playing the game on where those go in, at what point in your life, I'm making a bunch of money in my 35, I'm probably going to put it in at a normal IRA versus when you're young or when you're older.
That we always tell people is, if you know the future of taxes, then you know what IRA to use. We just realistically don't. But in my experience working with people who are coming up on retirement, even though there's an assumption that your expenses are going to go down, I don't see a lot of people who downgrade their lifestyle. So, the conservative way to plan is that the expenses aren't really going to change, because we do know that certain things are going to go up, so that, you want to make sure that you're planning. And again, you can't rely on, the things that our parents or our grandparents relied on. You really do. The other thing is that, people are living longer, so that retirement money is going to have to last longer.
Yeah. Yeah. I mean, you're older than me by a couple of years. I don't think most of my generation has even considered that Social Security was going to be around when we're like, I've always just assumed if it's there, great, but I'm going to plan like it's not going to be there.
Yeah.
And I still to this day am irritated with my grandmother. When I was 16, I started working. I said, oh, maybe I should start putting $50 a month into an IRA, literally at 16. And I was told not to do it because I was going to need that money for college. And I really wish I'd had that accumulated earnings from the time I was 16 instead of waiting another decade, when I got a real job. Such is life. So, well, Steve, this has been a great conversation. If anybody's interested in setting up a self-directed IRA or even just learning more about them, how can they get a hold of you?
It's really easy. They can call us at Inspira Financial. The general number is 800-258-7878. They can also send an email to our general email box, which is SDIRA at Inspira Financial. I'm willing, do we have a chat feature for this? I mean, I can. No,
but I will, anything that you have, I can put in the show notes after when it gets published. And then anybody can reach out and call that phone number, email that, or if you have any other contact information, I'll put that there as well.
I have a link that I'll pass on to you. The link will actually let them schedule a consultation with one of our IRA specialists. In 30 minutes, they can walk you through the entire thing. And again, those guys, I work with them really closely. I know that they have a great level of knowledge, especially those who came over from Quest. A lot of that stuff was drilled into us in our onboarding. So they can certainly tell you what you need to know. And again, that's one place where you can compare us to any other custodian that's out there.
Yeah. So if you have any interest in a self-directed IRA, you've got some money in an IRA someplace, you're thinking about moving it, or you're going to move it, reach out to Steve and his team. They can help you answer all your questions and get you set up pretty easy. So, Steve, this has been a great conversation. I truly appreciate your time, and I look forward to talking to you in the future.
All right. I do too. Thank you so much for the opportunity.
Yeah. Thank you. And thank all the listeners for joining. Don't forget to, if you got value out of this, to like this episode and share it with your friends. When you share it with people, this is how we get known. This is how I can continue to make these episodes that provide value to you. And so look forward to talking to you again next week on Brick by Brick. Thanks for tuning in to Brick by Brick Wealth Building Conversations. If you enjoyed today's episode, don't forget to subscribe and leave a review. It helps more people find the show. For more tips, resources, and updates on my journey, follow me on Invest with Loren. Let's keep building wealth, one brick at a time. See you next week.